All right, so we're on the part of the this question for Rasamu, where we have to now prepare statement of profit or loss and other comprehensive income for the year ended 31st December 2022, and also we have to make the statement of financial position. So basically, we just have to make the basic financial statements, which are the income statement. The income statement consists of the trading account and the statement of profit or loss. And then finally, we have the balance sheet. All right. So, colleagues, what is the purpose of the trading account? The purpose of the trading account is to get your gross profit. All right. That's what you want to find out, your gross profit. Okay. So, this is how we start the format for the trading account. All right. You will start with your sales revenue, how much you made in sales that year. All right. If we go to our uh, trial balance on sales revenue, it was 309,000. Were there any return inwards? I don't think there was any return inwards. Yes, so no return inwards. There was only return outwards. So if there was return inwards, colleagues, you would deduct from your sales revenue. Okay, because remember those are the goods customers are bringing back. All right, so it means since they bring back goods, so the sales value has to reduce. Okay, so we do not have return inward, so we leave it like that. The next thing we have to tabulate is the cost of sales. The concept of this trading account comes from that formula which says profit equals selling price minus cost price. All right. So in this case here, our selling price, sales revenue, and our cost price is the cost of goods sold. All right. Information we want. We want our cost of goods sold. Those goods that were not sold, their cost is not important. So, in order to get our cost of goods sold, the first thing you need to do is you indicate your opening inventory. These are the goods you started with at the beginning of the year. All right. This is their cost, 37,600. After you've got your opening inventory, the next thing you need to do is to add your purchases. Since these are also goods that you're going to resell, so you need to add in your purchases. But before you can add in your purchases, you have to check if there are any purchase returns, return outwards. Remember, return outwards is a contra expense account, meaning it reduces the purchases expense. All right. So in our trial balance, purchase returns was 22,100. So you deduct, I forgot to put a bracket here to show that we're deducting. You deduct purchase returns from purchases. All right. So 216,000 minus 22,100 is 193,900. So this is the cost of the purchases after we deduct the return outwards. All right. So the next thing that you're going to do, you add your opening inventory plus your purchases price. A lot of people forget at this point to add these two and just go straight to deduct closing inventory. So always remember this opening inventory here, add it with the purchases. All right, so this amount gives you the total cost of goods available for sale. All right, this 231,500. This is the total cost of goods available for sale. Now, before we go any further, any questions? Okay. After you get your total cost of goods available for sale, you deduct the closing inventory, the goods that haven't been sold. This is their cost, all right? In order to get the cost of goods sold. So to get cost of goods sold, you say total cost of goods available for sale minus closing inventory. Should have put also a bracket here to show us we're subtracting. So 231,500 minus 51,100. Our cost of goods sold is 180,400. That is the cost of goods sold. Other books see it as cost of sales. The book COGS, same thing. All right. Then to get your gross profit, it's the sales revenue, selling price, minus cost of goods sold, cost price. And that's how you get your gross profit, 128,600. So this is your gross profit. And this is where the trading account ends. Any questions? Okay. After you tabulate your gross profit, you need to look for any forms of income or other forms of revenue. Right? If you hear, like for example, discount received, that's a gain. All right, you add it to your gross profit. If you hear rent received, commission received, anything that has a received at the end, you add it to gross profit. All right, those are forms of, they are gains which can be taken as forms of revenue. So you add them to the gross profit. All right. But in this case, you don't have any discount received, commission received, rent received. You don't have any of that. So we go straight to deduct the expenses. So this is where the statement of profit or loss begins. The main purpose of the statement of profit or loss is to get our net profit. All right. Net means after we have deducted all these expenses, the profit that remains. All right. So we tabulate our wages. Okay. We start with wages. Right. Remember, there were some adjustments made to wages, and the new value that we got was 43,600. Management salaries. Was there any adjustment to salaries? No, I don't think so. For the salaries, it was just this 25,000. Electricity and water, there was also an adjustment to it. After we made the adjustments, it was 12,000. Running expenses from the trial balance, 6,900. Advertising expenses, There was an adjustment for that prepayment that we made. After we made the adjustment, our new value for advertising expenses was 14,600. Interest paid, this amount was from the trial balance, this 1,700. Depreciation on premises, computer and equipment, fixture and fittings. We tabulated these, all right, calculated these amounts. Irrecoverable debts, the money we will not receive. We sold to people and on credit, and we determine maybe they went bankrupt, maybe one might have passed on, something happened. So we've determined we're not going to be able to get this money back. So this is the irrecoverable debts, also called bad debts. So it's a bad debts 25. We also have an increase in the allowance for receivables. All right. Also, this we had to calculate this. So it's 200. If there was a decrease in the allowance for receivables, you would have added it to gross profit here. Okay, but since it was an increase, so we treat it as an expense. Because an increase in the allowance means that the money which we're expecting we might not get has actually increased by 200 kwacha. So that's treated as a loss which we are foreseeing, which can be treated as an expense. You add up all the expenses. Goodness with a statement of profit or loss, it's just expenses. That's all. If there was any form of revenue, also the revenue and expenses. Okay, so you add all of them, they add up to 114,650. To get your net profit, it is gross profit minus the total expenses. 128,600 minus 114,650, we get 13,950. That's our net profit. And that's where the statement of profit or loss ends. Any questions? Okay, so now we get to the balance sheet, the statement of financial position. Yes. Okay, so we go to the statement of financial position, which is also called the balance sheet. The accounting equation, which says assets equals liabilities plus capital. That's the whole essence of the balance sheet. Your total assets must equal the total liabilities plus capital. So now the first thing that we need to do, since in our trial balance, we've seen here a current account of 6,700. The purpose of a current account is to keep the capital account fixed. All right. So usually whenever you're doing a balance sheet, you always see that part which says that add capital, add net profit, deduct drawings. That section is going to be put in the current account because want the capital account fixed. That's why this current account comes in, because you just want your capital account to stay at a fixed number. So the balance for the current account, this account also increases with credit. So the balance brought down 6,700. The profit you credit to the current account 13,950. All right. Then drawings you debit to the current account, right? So any debit entry is reducing the balance, right? So you debit to the current account the drawings. So we find our balance, all right? So the current account has, it's more like a capital account too. It also increases with credit. So the balance brought down usually should be on the credit side, all right? So we get the totals. So the heavier side is the debit side. So our balance carried down will be brought on the credit side. Yes, Mr. Manasseh, yes, total assets equals total liabilities plus total equity or total capital. Equity is when you are dealing with a company. Capital, so trade. So you add up 6,700 plus 13,950. I'm not sure what number you get. Let's get our calculators. 67 plus 3950. So the higher side is the debit side. So our balance carried down is coming on the credit side. So a debit balance in this current account, it's more like you are owing the company. You took out more money than you have within the company. So it's like you are owing the company some money. So whatever number you get, deduct it from 22,900. You're supposed to get 2,250. And then the balance brought down comes here on the debit side, 2,250. So in the balance sheet, this debit balance will be represented as a negative. So it's usually partnerships that usually use current accounts, but uh, that's in that's called the capital account to be fixed. But even you as a sole trader, if you say I want my capital account fixed, you can bring in the current account. So we begin with the balance sheet. We're going to list our non-current assets first. Amount of words. So you have three columns. You have the cost, accumulated depreciation, and net book value. Colleagues, where are these values coming from? This 23,6, 18,150, and 12,000. Where are they coming from? When we tabulated depreciation, all right, remember depreciation, whenever you get your depreciation charge, All right. Whenever you get your depreciation charge, you debit the depreciation expense. Other books say debit the profit or loss, and you credit accumulated depreciation. All right. You debit the depreciation expense and you credit accumulated depreciation. All right. So in this trial balance, we already had information about the accumulated depreciation, which is here. Provisions for depreciation, also called allowance for depreciation, also called accumulated depreciation. So premises, it was 22,000. Then this year there was a depreciation charge of 1,600. So you say 22,000 plus 1,600. Excuse me, you get your 23,600, which is here for premises. The same with computer and fixtures and fittings. The depreciation expenses you tabulated, all right, you're going to add them to the existing accumulated depreciation amounts. That's all got 18,150 and 12,000. All right. So as I said, this accumulated depreciation, as it increases, the net book value of the equipment goes down. So as you can see, to get the net book value, it is cost minus accumulated depreciation. So the accumulated depreciation is increasing, the net book value of the asset is going down, right? Because remember, depreciation is the loss in value of an asset over time. So it's 8,000 times 23,600, 56,400. 30,600 minus 18,150, 12,450. All right. This is the worth of these assets at the end of 31st December 2023. 16,000 minus 12,000, 4,000. All right. You add 56,4 plus 12,450 plus 4 pin, 72,850. So that is the total value of the non-current assets. Any questions? Rasamu, part B, statement of financial position. Statement of financial position. Mm, yes, yes. But I'm recording, so yeah, yes. We cruised during the first one. Ah, that was cruising ish. That we cruised. Ah, I think we took 5 minutes. Everyone understood. So they can explain to you. No, they'll be able to explain to you. Silence indeed means a lot of. Ah, yes, but there'll be someone in this group who will be able to also explain to you. Do not worry. All right. Yes. Okay. Yeah, you know some, but I know, like for you, you're not totally blank. Okay, so the next section is the current assets. Okay. Our trade receivables value 35,000. All right. I hope we remember how we came to this 35,000. Remember, we deducted those, the irrecoverable debts. Those that came to 35. All right. Then we also deduct the allowance for irrecoverables. Right. When we tabulated, it was 1,400. On the statement of profit or loss, you're just putting the increase or the decrease. But in the balance sheet, you're putting the actual amount that you calculated. Right? So do not put that 200 kwacha increase here. No, it will be wrong. So you deduct 1,400 from 35,000. You get 3,600. Right? This is the value for our trade receivables. You add closing inventory from additional information. You add bank and cash, 8,050. You add the prepayment for the advertising, this 2,400. Okay. Then you add your current assets, you add all of them. Please, someone have a calculator so that we are verifying this. So I'm not accused of lying. Okay, so have a calculator. 33,6 plus 51,1 plus 850 plus 2,400. Our total current assets 95,150. So what you're supposed to do is you add the non-current assets 72,850 plus the current assets 95,150. So that your total assets come to 168,000. It's bulky. Financial statements. That's why we answer them last. Okay, then next is the capital section. So since our capital account here, it will be 80,000. So even next year, the other year, and the following years, it will just remain at 80,000 fixed. The only thing that will be changing is this current account balance. So where the debit, mhm, yes, you can put negative. Sure. Yes, you can. So you can put negative. You can put brackets. Okay, whichever you want to use, or you can even say less. You can just put the word less, whichever you're comfortable. He was asking why I put a negative here instead of brackets. So I said you can put either. If you want, you can add less there, less than. So 80 minus negative 2,250, you get 77,750. We come to our liabilities. Current liabilities, we have our trade payables, 26,550. We have those accrued wages, 3,700. And no other current liabilities. You add 2655 plus 37, 30,250 total current liabilities. Our non-current liability, this bank loan here, 60,000. Yes. Mm-hmm. The 60,000. Yeah, just get the 60,000. Then you add 77, 750 plus 30,250 plus 60,000. You're supposed to get 168. Excuse me, 168,000. And you are done. So in the exam, if you find maybe I made a mistake somewhere, it doesn't balance, and they're saying 20 minutes remaining or 5 minutes remaining, so long as your format is okay, you can end there. But if you've got a lot of time, you need to backtrack now. You say, okay, let me see. Go through all the transactions to see where you might have made a mistake. Because you get your full marks once it balances. If it doesn't balance, you're not getting the full marks. Okay, since the recording is done now, we can ask questions. We can ask